Good morning, traders. It is Friday. Happy Friday, the 19th of February, 2016. It's 8:02 a.m. Chicago time. Derivatives trading involves substantial risk of loss and is not suitable for all investors. Past performance is not indicative of future results. Now, let's just talk about here. Oil is off by 3%. We see the yen, gold, and the euro topping the list of futures I look at. This is more of a flight to safety or risk averse stance. In the overnight session, we see the markets dropping back down to 1905. So overall, the sentiment is defensive coming into today's session. As far as what's ahead today, uh, well, we did get CPI this morning at 0%, expecting negative 0.1%. Ex food and energy 0.3 versus 0.2. So you can see that the energy component's weighing heavily on that index. Other than that, looking at what's ahead today, the only key thing that's ahead is at 9 o'clock Central, just a half hour after the open, 10 Eastern. We have the European Consumer Confidence advanced number, expecting negative 6.6, and then the Baker Hughes rig count at noon Central, 1 Eastern. Not sure if that has any consequence anymore. But other than that, we're just basically trading technically. Let's take a look at what we did yesterday. If you recall yesterday's expectation, the primary hypothesis did not work out. The primary hypothesis was for it to open, respond back to around 1922, 1921, chop around, and then start moving towards that 31, and then ultimately back up to the 1940 CLVN, and that was also the prior high. So let's take a look at that. You can see the dip here, the dip right here, and then we had the last time we were up here, the high was 1940, as you can see right there, 1940. That's what was expected yesterday. But then I also talked about hypothesis, the second hypothesis, which was I had said that it has just about an equal amount of probability in playing out given the three gap day run that we've had. That's a very unusual run. And the expectation is that the sustainability of that run is not very high. The second hypothesis was to try to test higher immediately, then respond, drop through, and then the last frontier was 1916. 1916 was expected to hold it for a bit, and then it's likely to drop to the um, the initial test point from Wednesday at 11 and a quarter, which turned out to be the low of the day here, 11 and a quarter. So we went up against that first bar on Wednesday, first 15-minute bar high on Wednesday before the pullback and then the launch. But the expectation was it was likely to drop all the way back down to this 1906 CHVN. That was Hypo 2. It didn't quite complete that. We had a very oddly shaped double distribution yesterday in a fairly small range, relatively small range of 16 points. A double distribution with the LVN of this distribution right here at 1918, 1917.50, and that's the price that I'm likely to watch today if it does get back into the range. The overnight session has showed some pretty significant weakness. So you can see here, market just sitting sideways through most of the Asian session. The European session starts. We end up pushing to highs. We have a weak high overnight, and then from there we start to move down in an impulsive move. Initially, this was the impulsive move here, and then this looks like the continuation move, and we keep pushing lows back down to a 1902.50. 1902 quarter being the overnight low. So we're back into the FOMC range from earlier this month. Fairly bearish behavior overall in the overnight session. So also note that one of the key things to take away from the overnight session is the shape of the profile. The shape of the profile is such that the overnight session shows value in this white here, but there's really no value. The market has not found consensus and has thoroughly traded the entire range um, based on the profile. The volume is fairly decent, 337,000 so far. It has traded the entire range pretty thoroughly. This is a pretty significant test lower, in my opinion. So even though the primary idea in auction theory is usually for the market to respond back to the most recent auction or the most recent value, we still have to go by that idea, but we also know that we have a gap zone beneath us, which is marked right here, gap zone from the 17th. This gap zone here, the gap close of this gap zone is 88.50. We're trading just on the edge of the gap zone. The primary expectation is for responsive buying back up towards 1911, and then I expect a fairly significant amount of resistance to push us through to the mid of the gap at 1898, 1900 area. That's what I'm looking for. So the primary hypothesis is for responsive buying back towards yesterday's range, back up towards the 1910, 1911 area. I expect sellers to step in at these prices, and then I expect that the market to test at least the mid of the gap at 1898 and a quarter, potentially finishing to the other side. The daily range is such that it would be from around 1910 to 1890. That's 20 points. That's well within a day's range on the sell side. So the extended target would be the point of control, the naked point of control at 89.50, and the gap close at 88.50. That's the primary hypothesis. Secondary hypothesis is for it to test lower, push through on the open, chop around, and then attempt to go higher, and then build a profile right in this zone. We've seen this many, many times over the years where the market leaves a gap zone behind, or a low volume zone, and then it comes back and it just auctions the heck out of it. It is Friday. It has been a short week. It is Friday coming into the weekend, and that could lead us to see a lot of two-way action on the open, and then a fairly sleepy session later in the afternoon. But the second hypothesis is the strong potential for lower, higher, and then being stuck in the middle here, and forming what would look like a balanced profile. Those are the two key hypotheses for this session. I'll keep this short and sweet. I apologize for coming in late. The weather's nice here in Chicago, so I ran into the office on foot, and being as I haven't done it since last summer, I did it in a lot slower time than I expected. In any case, I want to remind you that it's Friday. I want to remind you that it is just so much more important for you to maintain a significant grasp on the process that you're going through today for trading, the plan that you're going through today for your trading, rather than the outcome. If you are an outcome-based trader, then your experience as you go through your rough patch or whatever reason you're listening to me for, your process is going to be a lot more turbulent. And you know, I don't say that lightly. I know it's very, very difficult to separate the emotions from the action that we see and the fact that we have our money tied to each trade, and it's a significant amount of money with every stop. But you want to maintain a strong grip on the process you're going through. It is the process, in my opinion, in my experience, and I've backed and trained quite a few people um, personally. Um, it is the process that is likely to see you through this if you're going to stick with it, and if you do have an actual edge. And most people, in my opinion, that I've run into have some sort of an edge. If you're following a if you've been demoing your trading plan and you're following it religiously, and you're penalizing your limit orders by a tick to get a more realistic fill that it has to trade through your price, and you're executing it and it shows profitability in a simulator, but you go to a live market and your results are very, very poor. That's a very, very, very common experience for most traders. If you're seeing that, then that is further evidence that there is an edge in how you're reading the market and how you're trading the market. Executing it is a psychological, emotional problem. And the only way I know around that problem is to simply focus on the process. Just like a golfer, focus on the process of swinging the club, that the arc that the head of the club is moving through is very important, rather than how far you can hit the ball, whether it lands on the fairway or not. Just focus on taking the best swing you can take, and then eventually you'll connect with the ball properly, and then you'll start to exert um, your own little touch to control the direction of the ball. And it's a lengthy process, but it is a process nonetheless. It's very, very important for you to know for a fact, by the way, that you do have an edge. If you don't know and you're just trading and you're just gambling, I suggest you switch to a simulator, get serious about tracking your results on a simulator, and establish that yes, in fact, you do have an edge, that you're not in a simulator, piling on with 10 lots and 100 lots on bad trades until they turn because you have infinite money. That doesn't help you. Practice the way you intend to play. That's what professionals do. That's what you have to do. But for today, focus on the process and focus very, very severely on managing the risk and selecting. Tell yourself you only have so many opportunities today to do something with the day, and get very picky about what trades make sense to you. So you need to just sit and wait. You're not going to miss anything. Ignore all the tweets and chats and texts and Skypes and whatnot that tell you how great a trade somebody else caught. That is not your trade. It should not influence your decision as far as whether or not you'll interact with the market. That's the best advice I can give you to keep you in the game, and that's the whole point of these trader bites and everything else that I do, is to keep you in the game as long as possible so you have a chance at making the turn rather than coming in, blowing up, and disappearing very quickly. Good luck to you, and I'll catch you on Monday. Take care.